Hey guys, welcome back to the channel. In today's video, we're going to talk about what is a stock. On its most basic, simplistic form, what is a stock? If you try Googling this, Google's going to tell you that a stock is a share in the ownership of a company. However, when you hear that, it might just lead to more questions. Specifically, how exactly am I an owner? Where did the stock originally come from? How does the stock make me money? And why does it have value in the first place? Let's talk about that in today's video. When a new company is formed, or when it starts up, it's exactly what you think it is. It's a startup. These are companies that probably eventually will be traded publicly. But in the beginning, they start out as sole proprietorships, partnerships, LLCs. And in order to scale up your business or increase your business, you need money. You need money to hire people, open offices, buy equipment. Waiting for your business to naturally turn a profit for you to slowly expand, it's exactly that. It's too slow. So by incorporating and issuing shares, you can take on new investors. And by taking on new investors, you avoid personal debt and risk, and you basically share the risk by sharing the reward as the company becomes more profitable. And in this initial quest for a startup to find investors, these are often called venture capitalists or angel investors because Class A shares are going to be created. Who are these venture capitalists or these angel investors? They're very, very, very rich people. These are probably billionaires. These are people who made it big in the 80s and 90s, and they're older now, and they enjoy this. They enjoy researching new companies, talking to young people with new ideas. They like having, an idea pitched to them, and then they just toss their money around. So these Class A shares that are created, what are they worth? And that's kind of complicated because the startup company basically has to negotiate with the venture capitalist how much all of their ideas are worth, what their potential worth could be. And that basically dictates what percentage of the initial shares that the venture capitalist will receive. The other shares usually end up going to the original founders or the original creators or employees of this company. So the venture capitalist gives money to the company then gives shares or partial ownership of the company. Now, obviously it's a negotiation, but generally this is what the balance sheet of a company will look like. On the left side, you have assets, and assets can be anything of value to the company. Cash on hand, equipment, patents, copyrights, trademarks, offices, and ideas? Yeah, ideas can also have value. And in order to determine what the shareholder value should be, you have to subtract your liabilities. These are bonds and debts. So it's a very simple formula. Assets equal liabilities plus equity, or equity, which is what we're trying to figure out, is equal to your total assets minus your liabilities. So let's do a quick math example for these Class A shares. Let's say that you've been, working on your own as a startup without any outside help. I don't know how you did it, but you were working hard. And your total assets of the company you value at around $10 million. But you have taken on some debts somehow. I don't know how you got $2 million in loans, but let's pretend you have debts. So we're going to do 10 minus 2 is equal to 8. And when you first created the company, this is a lot, but let's say you issued 1 million shares. And the equity of the company is 8 million divided by the total shares. Each share price, or the value of a share in the company at this point, is $8 a share. Now, as I said earlier, there's a negotiation process, how many shares the venture capitalists get and how much the original employees and founders get in the company. But I'm just trying to give a simplistic view of what happens in the inception of a new company. However, it's usually never enough money. In the beginning, you burn through cash really fast as you're hiring people, buying equipment, opening offices, maybe building up an inventory. So often these companies need to do additional rounds of funding, and these are just called Class B shares, Class C shares, Class D shares. And these are usually new investors. the original angel investors basically have a stake in the company now. If the company goes bust, they lose everything. So usually they will network and call their rich friends and say, hey, I got this hot new company that's up and coming. Consider investing with them. You know, go meet with the original creators and look at their business plan. And if you see potential, you know, chuck a lot of money their way. But all of these rounds of investments in order to build up the company lead to what you might guess, the initial public offering. And an IPO is really important for a company because it's the best way to get the most amount of money in order to start growing their business at a certain point. And in order to declare an IPO, you basically have to partner with one of these financial banks, and they look over all your books, they do a bunch of research. They then compile all your information and disseminate it. They're not working for free. They're charging you for this service, and it's usually like 7% of whatever you take in from the initial IPO. But they go to their prime brokerage account holders and institutional investors at all the big banks, Goldman Sachs, Morgan Stanley, Merrill Lynch, HSBC, and they say, hey, there's this hot new company. This is their business plan. These are the numbers, what they currently have, their debts, how many current investors there already are, how much they've put in the company. We project, you know, this is what the share price initially offered should be. And they offer these institutional investors, prime brokerage account holders, basically preference to buy in the IPO at this price. However, after the IPO happens, any of those shares that were purchased can now be bought and sold secondhand to the general public on the New York Stock Exchange. And for a brand new company, this is a pretty exciting time. They usually try to undervalue the share price because as soon as it goes live to the public on the New York Stock Exchange, they want generally the prices to go up, so it looks very exciting for the company. If the IPO isn't valued well and the share price goes down, it just kind of causes a panic amongst the original investors. Now, when you think about those angel investors in the round B, C, D, and E, they can sell their shares, but it's usually at a specified time. It looks really bad if the original investors in a company all, you know, unload it the first day of the IPO. So there's usually a kind of an agreed upon time when they make the initial investment, when they can start selling their shares on the New York Stock Exchange. And that, in a nutshell, is capitalism. It's people who have capital, money, funding private companies until they can become publicly traded. And these capitalists, they reap the rewards. Usually, the growth they see, the return they see on their initial investment is 5, 6, 7, 8, 9, 10 folds. If you were one of the original investors in Apple, that is the largest company in the world right now. But they also assume all the risk. For every successful company you see go public, there's probably dozens and dozens that never get there. They just fail in the inception. They don't make it past whatever round of funding. They never make it to the IPO. Their business model just isn't sustainable. And then those people, the company has to declare bankruptcy, but those people end up losing most of what they invested. So if you're watching this video and you buy and sell stocks on the New York Stock Exchange using discount brokerages like Robinhood, E-Trade, Webull, you're basically buying secondhand goods. You're buying remnants of all of this initial investing, and they're basically like cool artifacts. I don't really see a difference between people buying, for example, baseball cards or Magic the Gathering cards, and they assume that they're going to go up in value over time. That's a little bit what's happening when you buy and sell stocks. You're not giving the company money directly. You're not, it's weird because the transactions are all peer-to-peer. When you buy a stock on the New York Stock Exchange, you're not doing business with Apple. You're not doing business with GM. You're buying it from somebody else who bought it from somebody else who bought it from somebody else, and it's just this unbroken chain of, potentially millions of transactions. So day to day, in the long term, what gives a stock value? Let's talk about this, because when you look at that balance sheet, the very basic balance sheet of assets equal liabilities plus equity, Let's pretend whatever company we were originally talking about has 10x'd in size, and their assets are now valued publicly at around $100 million. Their liabilities are at $30 million, and the shareholder value, the equity in the company, is worth $70 million. 10 million shares now exist total, so 70 divided by 10, you should have a stock share price value of $7. However, this doesn't always happen. Now, when you are publicly traded, you have to open up your books and release all your financial information every quarter for the public to examine if they want to. But sometimes the stock value does not match up with whatever the book explanation of what the equity is worth. So you have to look at market capitalization. This is the number of shares multiplied by the share price. And the market capitalization doesn't always equal what the equity in the company is listed at. So let's do an example here and say that the assets were worth $100 million and now they're worth $110. There's this weird gap right here, and what is that? What's happening here is that the market capitalization is saying this company is only worth $70 million. However, the share price is currently undervalued. On the books, the share price should be $8. But when people are buying and selling on the New York Stock Exchange, they're the ones who set the price. The price listed is whatever the last sale was sold at. So if this is happening, then the share price should be $8, however, it's being sold for $7. This could be because people don't necessarily believe what's on the books, or they think, you know, there's something bad about to happen and that this company is either going to take on more debt, you know, debt would slide this down, or they think that the company's assets are going to go down. Either they're going to lose cash or they're going to have a bad quarter worth of sales and performance. So when the share price trades below what the on-book share price should be, it's because the company is not valued at full worth. And the exact opposite can happen as well. The assets on the books do not match what investors are paying for the stock price. So let's say the assets on the book is only $90 million. However, you know, this is the market capitalization over here. It's spilling over. It's worth more than what is happening on the books. The share price trading publicly is $7. However, it really should only be $6. And what's happening here is a couple things. Basically, investors are predicting that this company is growing and it's going to become more valuable in the future. So they're just trying to buy now because they think that share price is going to go up and up and up. And they also can basically be valuing something in this company that on the books is not valued. A good example in the news recently is Tesla. Their share price skyrocketed for no discernible reason. But people were saying, hey, this is a hot up-and-coming company. Yes, they haven't, you know, unloaded the new Tesla Cybertruck yet, but we think this is going to be a big seller. So people, once again, will pay whatever they feel like the company is worth. I don't really have time to cover it in this video, but there are ways that companies can manipulate their stock price. They can either issue new shares, and ideally, if you're issuing new shares, you're accumulating assets. However, when this happens, the share price will usually go down. Companies can also buy back stocks, and buying back stocks is very popular because that will artificially, well, not artificially, it'll inflate the stock price because you're destroying shares. By eliminating shares in the denominator, the market cap goes up and you can increase your share price by buying back stocks. But what gives a stock its value? And it's just you. It's just you holding it, wanting to sell it, and somebody out there wants to pay more for it than you paid for it. It's as simple as that. There's also dividends. You know, companies will pay out sometimes a quarterly or yearly dividend. That has value, but mostly a stock's share price is the appreciation and value given by other people. Okay guys, if you enjoyed this video, give it a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I'm going to post a couple more videos this week about stocks, and I'll even show you my Schwab brokerage account. And if you have any questions or comments, leave me one down below. I do my best to explain what I can. I am not a financial expert, and we'll leave it at that.